Welcome, everyone, to this explainer. The next time you're buying bondisol at the corner bakery, or maybe checking the exchange rate to send a remittance, I want you to realize something. There are massive, invisible macroeconomic forces at play behind those simple actions. Today, we're going to enthusiastically break down those exact forces that shape our daily financial lives. And we're going to do it through a very specific lens, the Bangko Sentral ng Pilipinas, or the BSP. Their ultimate goal is maintaining price stability to ensure balanced, sustainable economic growth. Everything we're talking about today really builds up to that one core mission. So let's just dive right in with a super fundamental question. What exactly do we associate central banks with? For a lot of folks, it's just this mysterious, monolithic building that only makes the evening news when interest rates jump up or drop down. But to truly grasp their power and their purpose, we've got to peel back a few layers first. Here's our roadmap for today. We're covering 1. The core of central banking. 2. Defining functions of money. 3. Measuring money by liquidity. 4. Tracking money by origin. 5. BSP and price stability. And finally 6. Global balance and final thoughts. Okay, starting right off with Section 1, the core of central banking, understanding the basics. Now, economists don't just look at money as the paper bills sitting in your wallet. To really get central banking, we have to understand that money is actually defined in 3 distinct ways. We can define it by its function, basically what it does. We can define it by its composition, which is what it's made of. Or we can define it by its nearness to cash, which is a financial concept we call liquidity. Moving on to Section 2, defining the functions of money and what it actually does for us. Money serves 4 explicit functions that make our entire modern economy possible. First off, it acts as a unit or measure of value. It's basically the yardstick we use to price things, so we know exactly how many apples equal 1 pair of shoes. Second, it's a medium of exchange. This means you don't have to literally trade your chickens for a haircut, right? It gives us a universally accepted token. Third, it's a store of value. You can earn it today, save it, and it'll still hold value tomorrow. And fourth, it serves as a standard of deferred payment, which allows us to create contracts for the future, things like mortgages or car loans. And this brings us to a really fascinating paradox called the vicious cycle of money. Money can perform those 4 functions because it is widely acceptable, and it's acceptable because it performs those functions. Acceptance and function are just constantly reinforcing one another. If one breaks down, the whole system just collapses. That brings us to Section 3, measuring money by liquidity, moving from cash to complex assets. So not all money is created equal when it comes to spending it right this second. Think of liquidity as a spectrum of how fast you can buy a coffee with your assets. Economists measure this nearness to cash in tiers, categorized from M1 all the way down to M4. Each step down this list represents a broader and slightly less liquid category of liabilities held by financial institutions. Let's isolate the most liquid tier first, M1. This is the money that is ready to go right this very second. It's simply the physical, hard currency currently in circulation, the coins and bills, plus the money sitting in everyday demand deposits like your standard checking account. You can spend M1 instantly. As we move down the spectrum, things get a bit broader. M2 takes that M1 and adds quasi-money, like savings and time deposits. Then M3 takes M2 and tacks on deposit substitutes. Finally, we reach the widest end of the spectrum, M4. M4 takes everything in M3 and adds foreign currency deposits held by residents. A central bank has to keep an incredibly close eye on all these levels, from the hyper-liquid M1 all the way to the broad M4, to truly understand the health of the economy. Now, Section 4, tracking money by origin. Where does it actually come from? Money origin is pretty cleanly split into 2 distinct categories. It either comes from inside the house or outside the house, meaning domestic or foreign. But how is domestic money actually created? Well, it's not just printing presses going brr. We operate on a fractional reserve system. This means banks hold only a fraction of your deposits as cash reserves and lend the rest out. This creates a really cool money multiplier effect, organically expanding the total money supply as those loans are deposited and then relent over and over. Let's break that down just a bit more. Money of domestic origin is generated internally when the central bank or local commercial banks issue loans and credit. To manage this money supply and control that multiplier effect we just talked about, the central bank uses specific monetary policy instruments. They can change reserve requirements, which directly affects how much banks can lend. They can engage in open market operations, adjust loans and credit directly, or even use moral suasion to kind of informally guide banks' behaviors. On the flip side, money of foreign origin flows in from abroad. We're talking export proceeds, remittances, and foreign investments. Both streams feed the total money supply, and the central bank has to expertly balance them. Which brings us to Section 5, the BSP and price stability, the real guardian of the economy. Before we introduce the central bank's absolute primary goal, we need to clearly define what we actually mean by price. When economists talk about price stability, they aren't just talking about what you pay for rice or gas. Price encompasses consumer prices, sure, but also interest rates, which is literally the price of borrowing money, and exchange rates, which is the price of our currency relative to the rest of the world. So let's uncover the ultimate mission of the BSP. But first, actually, a quick bit of trivia. Did you know the BSP was officially established under Republic Act 7653, which is known as the New Central Bank Act, on July 3, 1993? It started with an initial capitalization of 50 billion pesos, and 10 billion of that was directly paid in by the Philippine government. Today, specific specialized branches like the Department of Economic Research, the Department of Loans and Credit, and the Treasury Department all work together behind the scenes to execute the objectives that form the foundation of the economy. And here is that core mandate. Every single word here matters. The BSP's goal is to maintain price stability conducive to a balanced and sustainable growth of the economy. They are also tasked with promoting monetary stability and the convertibility of the Philippine peso. Think about why this is absolutely crucial. If prices for goods, interest, and exchange rates are just wildly fluctuating every day, businesses can't plan for the future, and everyday citizens literally lose their purchasing power. Economic growth can happen. Finally, Section 6, Global Balance, and our final thoughts, putting all of this together. To maintain that critical economic stability we were just discussing, the BSP can't just look inward. It has to track the balance of payments, or BOP. Think of the balance of payments as a giant national ledger. It summarizes all international economic transactions for the country over a specific period, usually a year. It meticulously tracks the debits, which is what the country owes or pays to foreigners, against the credits, which are the payments received from the rest of the world. Keeping this ledger balanced is a massive part of maintaining the stability of the peso in the wider economy. So, as we wrap up this explainer, I want to leave you with two critical questions to really ponder. First, how does a change in the central bank's reserve requirement directly impact your daily purchasing power and local inflation? And second, why is maintaining price stability considered the core pillar for achieving sustainable economic growth in a developing country like the Philippines? Consider everything we've covered today, from that fascinating money multiplier effect to the global balance of payments. Thank you so much for joining me on this deep dive into the economics of central banking. Keep questioning, keep learning, and I'll see you in the next explainer.